right, thank you. Please, can we mute our speaker? And also, please, at this online class, as much as possible, let us maintain decorum. If you have any question, there are two options open to you. You can type in your question via chat, or you can raise up your hand, then we now ask you to speak. So please, at regular interval, please check your device, particularly your speaker, so that when this video is provided, you are going to have less interference with the video. All right, last week, we started discussion on dividend policy. Dividend policy is about the amount a company should pay as dividends. Should a company establish dividend policy or not? We define dividend as that percentage of the company's profit that is paid to the shareholders as dividend, as return. We say dividends is the percentage of the company's profit that is paid as return to equity shareholders. We also mentioned that dividend payment is not compulsory. A company can decide to pay dividends, or a company can decide not to pay dividends. Dividend payment is at the discretion of the company's directors. The company's director will decide whether to pay dividends or not. The company director will also decide amounts to be paid as dividends. It is the responsibility of the company's director to decide on dividend payments. We now consider the theories of dividends. This theory is about whether companies should have a dividend policy or not. Should company establish a dividend policy, or dividend policy is not relevant? We now look at the school of thoughts under the theories of dividends. We have the traditional theory of dividends. This theory believes that companies should establish a dividend policy, and that dividend policy should work towards maximizing the company's value. That is, companies should have an optimal dividend policy, a dividend policy that will maximize your value. And to obtain your value of company shares, we explain the calculation formula. We provide justification for the traditional schools that when you are paying dividends, these are the reasons why you should pay dividends. We explain Modigliani and Miller theory. Modigliani and Miller, irrelevant theory of dividends. This school of thought argues that dividend payments is not relevant to companies' market value. This school of thought argues that dividend payment is not relevant to companies' market value. If you like, pay dividends. If you like, don't pay dividends. That will not affect your company's market value. According to this theory, Modigliani and Miller, what determines company's market value is the company's earnings capacity, your earnings power. What determines company's market value is the ability of the company to generate earnings on your investment. The more earnings you can generate, the higher your value. The more you are making more profit, the more you are making more earnings, the more you are making more returns, your value will continue to increase. Your value is not dependent on dividends. Your value, MMM is saying that company's value is not a function of dividend policy. Rather, a function of the company's earnings capacity. They supported their theory with assumptions. We explained this last week. We discussed the residual theory of dividend. The residual theory argues that a company should pursue optimal level of dividend. Please, Victor, can you mute? Mr. Victor, please, can you mute?
Sorry.
Let's continue. The residual theory argues that there's an optimal level of dividend policy. And the optimal level is achieved by taking some steps. What are these steps? That if you want to achieve optimal level of dividends, then you should follow these steps. One is a company should first identify capital investment opportunities that are viable. A company should identify viable investment projects. Viable investment projects are projects with positive net present value. Identify viable projects first. These viable projects, invest in these projects, because by investing in positive net present value projects, that will increase the value of the company. And that will increase the share value. Next, the company should finance the viable projects with money generated internally. That is, viable projects should be financed from your earnings, your profits after tax. Earnings after tax. Finance the viable projects from your earnings. Then This third step. After you have exhausted all viable projects, company will only pay dividends after we have exhausted all viable projects and we finance all viable projects from the earnings. In other words, we are going to pay dividends after we have taken capital to finance viable projects, and the balance remaining will be used for dividend payment. That is, you are going to treat dividends as a residual decision. We explained this last week. We now look at the factors affecting dividends. We look at the form of dividend. Thereafter, we address question number 2. Last week, we addressed the question. Please hold on, Kemi. We addressed the question on, I think, number 2 or number 3. Tonight, we shall be looking at question 1. We are starting with question 1. Please refer to page 158, illustration 1. Yes, Kemi, please, your comment or question?
Good evening, sir. Sir, you said that the discretion of the directors to decide whether to pay dividends or not. Does that mean dividend decision is no more a part of the decision of the finance manager?
All right. Finance manager is also a director. Is that clear, please? For you to be a finance manager, you are the finance director and you are part of the management board. So the managing director will give you that responsibility. You are not going to advise the company that this is what I think we should do. So finance director is also part of the company's director. Is that clear, please?
Yes, sir. Thank you, sir.
All right. Please refer to page 158, Babayaro PSC. Page 158. Let us start with this question. All right. I'm sure we can move now. Babayaro PSC has been experiencing difficult trading conditions over the past few years. In the current year, net earnings are likely to be 20 million, which will just be sufficient to pay a dividend of 1 naira per share. The earnings and dividends for the company over the last 5 years are shown below. Between 2004 and 2008, look at the earnings per share and look at the dividend per share. Look at the trend. If you look at earnings per share is falling. Why dividend per share is rising? The next paragraph. There are 20,000, sorry. There are 20 million ordinary shares in issue. Mr. Abraham, please can you mute? There are 20,000 ordinary shares in issue, majority of which are owned by private investors. There is no debt in the capital structure. Members of the board of directors are considering a number of strategies for the company, some of which we have impacts.
Na accounting, no, ICAN. Now I keep this thing, go to enter inside.
Okorie, please can you mute? You want to transact your business, fine. But please help our class. Some of which we have impacts on the company's future dividend policy. The company shareholder required a return of 15% on their investment. The following 4 dividend payment options are being considered. 1. Pay out all earnings as dividends. That is option 1. The company is looking at pay out all your earnings as dividend. Option 2. Pay a dividend of 50% out of earnings and retain the remaining 50% for future investment. Option 3. Pay a dividend of 25% out of earnings and retain the remaining 75% for future investment. Option 4. Option number 4. Retain all earnings for aggressive expansion program and pay no dividends at all. In the light of the above exposition, you are required to A. Discuss the company's dividend policy between 2004 and 2008 and provide and its possible consequences on earnings. Look at the company's history. What can you say about the company's dividend policy? We need to discuss this. If you look at this, between 2004 and 2008, earnings per share is falling and dividend per share is rising. Let us now do some computation. Computation that will guide our discussion. Let us calculate dividend payout ratio. Dividend payout ratio is the percentage of earnings paid as dividends. Dividend payout ratio is the percentage of earnings paid as dividend. Now, please, I'm assuming that you have the question open. Let us go to the board for solution. Now, give me figure for earnings per share.
1.40.
1.40, next.
1.35.
1.35, next.
1.35 again.
1.35.
1.30.
1.20.
3.30.
Oh, 30.
Yes.
Then lastly,
1.25.
1.25. Now, please give us dividend per shares.
0.84. 0.88. 0.90. 0.95. 1.00.
Thank you. Let's go on with the class. Now, to calculate dividend payouts, your dividends divided by earnings per share multiplied by, look at it, 0.84 divided by 1.40 multiplied by 100. Please compute. Next.
60.
60.
Please, 60%. Go to 2005. 0.88 divided by 1.35 multiplied by 100. Let me expand this more.
65%.
Okay, I just want to expand this. It's looking small. Let me expand this so that I'll be able to show the working. All right. This will give me 61%.
65%.
65%. 2006, 0.90 divided by 1.35 multiplied by 100. Dividend payout, compute.
67%.
7%.
67%. Next, 0.95 divided by 1.30 multiplied by 100. What do you have?
73%.
The last one, 1.00 divided by 1.25 multiplied by 100. The percentage?
80%.
80%. All right, let's continue with the class. If you look at the trend, dividend payout is higher. Every year, dividend payout ratio is growing, is increasing. All right, please note that. Also, you can also look at between, let me move this a bit down. Let me come to the next page. Between 2004 and 2008, determine change in earnings. Percentage change in earnings. Look at it, please. In 2008, earnings per share is 1.25. In 2004, earnings per share is 1.40. I can calculate. In 2008, 1.25. 2004, 1.40. Divided by 2004 is the base year, 1.40. Multiplied by 100. Please calculate percentage change in earnings. That should give you negative 10.7%.
Thank you, what I used to my body. Thank you, what I used to my body. Anyway, each regardless. How you girls doing? How girls doing?
Adagu, please, can you mute?
Better keep my.
And that is the challenge. Every business has its own risk. Somebody in his own house will take his own business on. He will join the class. What can we do? The negative sign indicates a reduction in earnings. That means between 2004 and 2008, earnings reduced by 10.7%. Earnings fell between 2004 and 2008. The company's earnings reduced by 10.7%. That is the trend in earnings. That is the trend in earnings. Now let's go and look at the trend in dividends. In 2008, dividend per share is 1 naira. In 2004, 0.84. Let us determine percentage change in dividends. 1.0 minus 0.84 divided by the base year, 2004, 0.84, multiplied by 100. What is the change in dividends? You are going to have 19%. Positive sign. That means dividends increase by 19%. Between 2004 and 2008, the company's dividends increased by 19%. Can you imagine that? During this period, earnings per share declined by 0.7, while at the same time, dividend per share increased by 19%. You can now comment, you can now discuss the company's dividend policy. If you look at this company is paying dividends out more. The company pays dividends regularly. The company increased dividend percentage every year. Now look at the comment, please. The computation is to guide your comments. If you look at requirement A, we are not asked to compute anything. If you look at requirement A, examiner say discuss. Let's go back to that requirement. Look at the requirement, please. requirement A says, discuss the company's dividend policy between 2004 and 2008 and its possible consequences on earnings. From that requirement, you are not asked to compute anything. What you are asked to do is to discuss. But for you to discuss, you need to look at the computation that will guide your discussion. You now calculate dividend payout ratio. Your dividend payout ratio is the percentage of the company's earnings that is paid as dividend. We equally calculate percentage change in earnings between 2004 and 2008. We can now discuss now. This computation will guide our discussion. Look at the comments. The payment ratio has increased from 60% in 2004 to 80% in 2008. Thus, the proportion of earnings retained has fallen to 20%. Or the proportion of earnings retained has fallen by 20%. If you increase your dividend payout by 20%, that means your earnings has reduced by 20%. If you increase your dividend payout ratio by 20%, what you are saying invariably is that your earnings has reduced by 20% over a period. If it is assumed that the capital structure has not changed, then it can be seen that both actual earnings and return on capital employed have declined. What we are saying is, if you are paying out all your money, you are paying dividend out to shareholders, more dividend to shareholders, and you are retaining less. What it means is that you are reinvesting less in the business. You pay more, you are paying more. Most of your profit are paid as dividends. The implication is that you are retaining less. Your retention and reinvestment rate in the business will fall. If your retention and your reinvestment fall, your earnings will reduce at future period. One possible consequences of this policy is that insufficient earnings have been retained to finance investment required. Insufficient earnings has been retained to finance the investment required to at least maintain the rate of return. It then means that the company is falling behind. If you are chopping all your money, you are not reinvesting your money in your business. That means you cannot maintain your rate of return on capital. It means that Baba Yaro is falling behind his competitors, which could have a serious impact on the long-term profitability of the business. By paying 1 naira per share in the current year, will result in a fall in the share price. If you pay cash dividends, your cash dividends will reduce value of shares. This is the expected explanation as regards requirement A. Any question, please? All right, if there's no question, let us look at requirement B. Requirement B. Advise the directors of Baba Yaro PSC on the share price which might be expected immediately following the announcement of their decision if they pursue each of the 4 options using an appropriate valuation model, making necessary assumptions. This is ICAN tested question. What are the 4 options? Look at it, please. Look at the options. 1, pay out all earnings as dividend. If the company decides to pay all its earnings as dividends, what is the share price to be expected? Let us move to this, please. Let us move to this, please. All right, look at it. Option 1, pay out all your earnings as dividend. That means, what this means is that dividend payouts is 100%. If dividend is 100%, that means retention is 0. Retention ratio is 0%. If you are paying out all your earnings as dividend, that means you are not retaining any money. Remember this formula we used last week. Expected value of share is dividend bracket 1 plus G divided by KE minus G, where your D is dividends. Examiner says all earnings should be paid out as dividend. Please check, what is the earnings? What is the earnings? The class is silent. In the current year, net earnings are likely to be 20 million. That means all the earnings will be paid as dividend. That means our dividend is 20 million naira. That means our dividend is 20 million naira, 100% of earnings. You can get your growth rate. You can get your growth rate. Growth is equal to R multiplied by B. Your R is shareholders require return. Look at the question. It's in the question. The company's shareholder require a return of 15%. If I want to calculate growth rates for option 1, my R is 15%. Your B is the retention ratio. Let me state that out. B is retention ratio. This is equal to your R. That means 15% multiplied by 0%. That will give me 0. Our growth rate is 0. Your KE, shareholders require return, is also called cost of equity. That is 15%. You can now calculate expected value. Remember the formula here, please. Look at the formula. Expected value is equal to dividend bracket 1 plus G. And our G is 0. I can do like this. Value of shares is equal to dividend 20 million. Bracket 1 plus 0. Divided by 15%. 0.55 minus 0. That will give me 20 million divided by 0.15. Please, what is the value of shares? Maybe to 5 decimal places.
133.33.
Yeah, that's why I asked, because if you do that, you go and just do, if you give me just 133, that will not be good. You are going to get 133,333,333. Look at it. Total value of shares. Total value of shares is equal to 133,333,333. Now, this is the total value of shares. What is value per share? Expected value per share. Go and check. How many shares do we have in this company?
20 million.
Thank
20
you.
million.
We have 20 million shares. Now divide. Divide 133.333333 by 20 million. Divide this by 20 million shares. That will give you 6.67.
Yes, sir.
Work it out.
6.67.
That is the expected share price. If the company decides to pay all its earnings as dividend, share price to be expected is 6 naira 67 kobo. You are done with option 1. If the company decides to pay out all its earnings as dividends, then the expected share price per one share is 6 naira 67 kobo. We move to option 2. Look at option 2. Pay a dividend of 50% out of earnings and retain the remaining 50% for future investment. You can come here. Dividend is 50% of earnings. Please compose. Our earnings is 20 million. 50% of 20 million naira. That will give me 10 million. Your growth rate, R multiplied by B. Our R is 15%. Our B, that is the retention ratio. Percentage retain, 50%. Please multiply. 15% multiplied by 50%. What is the growth rate?
Growth rate is 0.075.
0.075.
Yes.
Then your KE, that is the required return, 15%. Let us calculate value. Total value is equal to D, 10 million, bracket 1 plus G, 0.075, divided by KE, 15%, 0.15, minus 0.075. Please work this out and give us total value. Your calculator will do it. Final answer.
143.3333.
143.333333 million. You can do it straight on your calculator. You don't need to be doing 1-1 and consuming time. That is total value of shares. Total value of shares is 143,333,333 million. Now, expected value per share. Number of shares in this company. Number of ordinary shares, 20 million. If now want to get expected value, please divide expected value per share. You are going to get 7 naira.17 kobo. Please reconfirm this.
It's correct, sir.
It's correct, sir.
That is the value to be expected per share. If the company decides to pay 50% dividend and retain 50% of the earnings. When you are done, go to option 3. Option 3 says, pay a dividend of 25% out of earnings, retain the remaining 75% for future investment. Let's deal with this. Dividend is 25% of earnings. Please compose. Your earnings is 20 million. 25% of 20 million naira. That will give you 5 million naira. Your growth rate, R multiplied by B. Our R is 15%. Our B, retention is 75. What is the growth rate?
0.1125.
Thank you, sir. Then your KE, that is the cost of equity. It's also called shareholders required return. Examiner say this is 15%. What is the value to be expected? Value is equal to our dividends, 5 million, bracket 1 plus 0.1125 divided by 0.15 minus 0.1125. What is the value to be expected? Yes, final answer.
One 1483333.
148.3333 million. This is the total value of shares. Number of ordinary shares is 20 million shares. What is the expected value per share?
7.42.
Expected value per share is equal to 7 naira 42 kobo. You are done with that. This was ICAN compulsory question. The last one, option 4, retain all earnings for aggressive expansion program and pay no dividends. That means dividend is 0. Look at it. Dividends payout is 0%. Retention is 100%. Retention ratio is 100%. If retention is 100%, then the growth rate will be what? Look at this. Our dividend will be 0. growth rate will be 15% multiplied by 100%. That will give us 15% back. You cannot use this formula because dividend is 0. If you look at the formula, it won't work.
Yes, because everything will be 0 back. Everything will be 0 back.
But share price cannot be 0. Have you ever seen stock market price being 0?
No,
Have you
sir.
ever seen?
No, sir, it can fall, but I don't think it can be 0.
My question is, have you ever seen 0?
No, sir.
It won't be 0. Now, what you are going to do here is that if you look at option 4 and option 1 is opposite. Is that not? If you look at option 1, pay out all earnings as dividends, retention 0. Option 4, dividends don't pay, retain all your earnings. Now you are not going to comment on this. In this case, for a share price of 6.67, where is that coming from? If we pay out all our earnings as dividend, the share price will be 6 naira 67 kobo. That means if we are retaining all our money, the company must use the money, must invest the money in a project that will give us 15% return. If the company is retaining all our money, the company must make sure that the money is invested in a project that will give at least 15% return. Once this is achieved, the share price to be expected will be 6 naira 67 kobo. Investor will need to believe that retained profit will be invested in project yielding annual growth of 15%, and that the share price will be at this rate 100% of expected return in the form of capital appreciation. What we are saying is, if you retain all the money, provided you can achieve 15% growth rate in your investment, the share price to be expected will be 6 naira 67 kobo. The opposite of option 1. That is what the examiner expects from you. It is only the growth rate we can monitor. Once we achieve that growth rate of 15%, the share price at the stock market will be 6 naira 67 kobo. That is that about that question. That is that about that question. All right, please carefully study it. Let's move to question number 5, page 159. Question 5, page 159. I have the question on my screen. Please confirm you are there. Are we there now?
Yes, sir.
All right. The question says, discuss whether or not an increase in dividends is likely to benefit the shareholders of a PSC. 8 marks. Discuss whether increase in dividends is likely to benefit the shareholders of a publicly quoted company, PLC. Now, let me hear your opinion first. Let me hear your opinion. If you want to speak, please, you can signify by raising up your hand. Okay. Now, what the examiner wants you to explain here is basically theories of dividend policy. What the examiner wants you to explain here is theories of dividend what policy. You are going to talk about the traditional theory. This theory says that it is good, it is beneficial to increase dividend payment to shareholders. The traditional theory says that it is beneficial to increase dividends to shareholders. By giving dividend to shareholders, you provide current income for the shareholders. That current, look at it. What the examiner is asking you is in your material. We discussed it last week. Let us go to that aspect. Maybe I should even copy it to support that position. Look at the answer here. Yeah, look at it. Preference for current income by paying dividend to shareholders, by increasing dividend to shareholders. It is beneficial because it provides the shareholders with current income. This current income can be used to finance consumption or can be used for investment. This implies that many shareholders will prefer companies who pay regular cash dividends. Shareholders will value the company more because dividend provides current income. That is the argument of the traditional school. Number two, dividend is a resolution of uncertainty. One argument often put forward for high dividend payout, look at it. One argument often put forward to support high dividend payout is that income in the form of dividends is more secured. The income you receive from your dividend is more secured than the income in the form of capital gain, than it should be done, than income in the form of capital gain. Investors will give more value to high payout shares. Investors will value companies, we value shares that pay them dividends, because that dividends remove uncertainty associated with capital gain. What is capital gain? If you dispose your shares, that is when you are going to get capital gain. Dividend provides you with a certainty. Capital gain is not certain. You can use this argument to say that increasing dividends is beneficial to shareholder. You can use this argument to say that increasing dividends is beneficial to the shareholders of a BSC. When you are done, you can now go to M&M. M&M says dividend payments, whether you increase or you decrease, will not benefit shareholders. You can argue that according to M&M, the payment of dividends will not affect the value of the company's shares. The payment of dividends will not affect the company's equity value. Hence, increase in dividends or decrease in dividends is not beneficial to shareholders, according to Modigliani and Miller. You can also argue that increasing dividend payments will reduce earnings available for retention. Increasing dividend payments will reduce earnings available for retention. Failure to retain earnings will affect the ability of the company to generate more earnings at future period, which will in turn affect return to shareholders. That was the discussion we had. Question 1. If you are paying out all your earnings as dividends, it will affect your future earnings capacity. That will answer requirement A. We can look at requirement B. Look at requirement B. Please, just 1 minute. Just want to take something closer to me. All right, requirement B. The board of directors of SEPTI PSC is discussing the level and nature of the company's next dividend payments. Three options are under consideration. Option 1, a cash dividend of, please let me change it to kobo. This is ACCA question. Let me change it to kobo. Cash dividend of 15 kobo per share. Option 2, 5% scrip dividends. Option 3, the company repurchases 10% of the ordinary share capital at the current market price and then pay a cash dividend as in one above. Next, summarize financial statements. You have the profit and loss statement for SEPTI. You have the balance sheet. Next, SEPTI current share price is 400 kobo cum D. That is including dividends. Requirements. Calculate the expected effects of each suggestion on a shareholder in SEPTI PSC owning 1,000 shares. Explain briefly how accurate your estimates are likely to be. Taxation may be ignored. Now, look at this question. We have, the company is looking at 4 options. We are now asked to calculate the expected effect of this option on a particular shareholder that have 1,000 shares in the company. Imagine you are the shareholder. You have 1,000 shares in a company called SEPTI PSC. If the company pay you 15 kobo dividend per share, what is the impact on you? What is the effect on you? Let's go to this. Let's go to this. Okay, I can start from here. Option 1, cash dividends of 15 kobo per share. Expected effects. 1, the shareholder will receive dividend. Look at this. 1, dividends received. You have 1,000 shares in the company and you are being paid 15 kobo per share. What is your dividend received? Multiply by 15 kobo. You can convert this to naira. 15 kobo divided by 100. That will give you 0.15. Please compute dividend received. This shareholder will get 150 as cash dividend. Next, by paying cash dividend, share price will fall. Look at it. Examiner says current share price Kundi 400 kobo. Get X dividend share price 400 kobo minus 15 kobo. That is, remove the dividend from the share price. You are going to have 385 kobo. That is the dividend share price. The share price is expected to fall by the amount of cash dividends. Implication 3, value of shares. You have 1,000 shares. Now, share price has reduced to 385. In Naira, that becomes 3 Naira 85 kobo. What is your share value? That will give you 3,850. If you do a summary, total shareholders' money. Look at total shareholders' money. Total shareholders' wealth. You are going to receive dividend of 150. Your share value was 3,850. Total shareholders' wealth is 4,000 Naira. For option 1, the total shareholder money is $4,000. That is the expected effect of option 1 on the shareholder. Option 2. Option 2. Option 2. Pay 5% scrip dividends. What is scrip dividend? Share dividends. Expected effects. Expected effects. 1. Number of new shares. Number of new shares. 5%. Currently, you have 1,000 shares in the company. Compute 5% of 1,000. Number of new shares. 50. The company will issue 50 new shares to you as dividends. Two, total shares now. Before you have 1,000 shares plus 50 shares given to you as dividends. Your total shares becomes 1,050 shares. The company has issued 5% script. That means you are going to get 50 new shares as dividend. Your number of shares will increase to 1,050. Three, current share price. The current share price will still remain
3.400.
No, please. We didn't pay dividend now. 400 kobo. Because option 2, we did not pay dividends. Share price will not reduce. Value of your investments, value of shares. You now have 1,050 shares. And the price per share is assumed to remain 400. That is 4 naira. What is the value of your shares? 4,200. That is the total shareholders' wealth. Please note, share price will fall by the amount of dividend paid. In option 2, dividend is not paid. Cash dividend is not paid. What we have in option 2 is scrip dividends. The share price is assumed to remain unchanged. Then option 3. Option 3. Examiner says 10% share repurchase. 10% share repurchase and cash dividends of 15 kobo. What is the expected effect on the shareholders with 1,000 shares? Expected effects. 1. Share repurchase. That means share buyback. Your share will reduce. Look at it. Number of shares repurchased. 10% of 1,000 shares. That is 100 shares will be repurchased. Out of your, if you want to speak, please signify by raising up. That's your side talk. We go into the video. So that if you want to speak, I can keep quiet for you. Number of share repurchase, 10%. That means out of my 1,000 shares, the company will repurchase 10%. They are going to collect 100 shares for me. Examiner says at the current market price. That means I'm going to receive cash. Cash received on share repurchase. Let me write this out very well, because some might not be in class tonight. They can look at what we have done. Cash received on share repurchase. On share repurchase. Examiner says the company will repurchase at the current market price. Current market price is 400 kobo. That means 100 shares will be repurchased at 4 naira. I'm going to guess $400 on my share repurchase. My share will reduce. Out of 1,000 shares, 100 has been repurchased. The remaining shares, 1,000 minus 100, that is 900 shares remaining. For these 900 shares, I'm going to receive dividend of 15 kobo per share. Look at it. Cash dividends received. 900 shares multiplied by 0.15. Please compose 135 naira. Because we have paid dividends, share price will fall. X dividends as dividend share price. That will be 400 minus 15 kobo. That will give me 385 kobo. Value of remaining shares. My remaining share is 900,000 at the rate of 3.85. What is the value here, please? $900 multiplied by 3.85. 3,465. 3,465. The investor will get this cash. Number of shares will reduce. We will get these dividends. Value of remaining investments. You have looked at the effect on the shareholders. You are done with that question. That statement is not your business. That is the company's statement of profit and loss. That statement, as far as this question is concerned, is not relevant to us. It is the statement of the company. But me as a shareholder, what is the effect of each of these policy on me? Any question, please? All right. Last question tonight to round up this topic. That is theory. So we are going to round up anywhere for now. Go to question number 4 on your study pack. See page 159. Yeah, look at this question. Why am I trying to explain this question? Your exam, you are going to have theories there. Financial management is a combination of calculation and theories. So while you do calculation, also read your theories. Look at question 4. Examiner says, mention and explain 5 factors that determine dividend policy of a large public company whose shares are quoted on the stock exchange. What are the factors that determine company's dividend policy? We have explained this before. We mentioned your dividend capacity. That is the amount of distributable profits. We mentioned availability of cash flow. We talked about level of profitability. We mentioned availability of viable projects. We talk about the level of taxation. Please read this up. Look at the B part. What do you understand by scrip dividends and scrip issue? Explain to us. Scrip dividends. This is dividend paid in the form of stock or shares. Scrip dividends. This is the issuing of new shares as a payment of dividend, as opposed to cash dividends. We explained this last week. Scrip issue. This is bonus issue. Issuing of new shares as bonus. Give 2 differences between these two. For scrip dividends, it is used as payment of dividends. And the shareholder can decide to accept or not to accept. For scrip dividends, it is used as payment of dividends. Shareholder can decide to accept or not to accept. For scrip issue, is a bonus issue. Shareholders cannot reject it. For scrip dividends, it is paid usually at the end of the financial year. Bonus issue can be done at any time. That is, scrip issue can be done at any time. Scrip issue is the recapitalization of equity reserves. That is C. D part of the question. Examiner says it has become increasingly common for companies to offer their shareholders a choice between cash dividends and an equivalent scrip issue of shares. It should be scrip dividends, not scrip issue. Okay, I can leave it. Issue of shares. Briefly consider the advantages of scrip dividends from the viewpoint of both the company and shareholders. Look at this question. What are the advantages of scrip dividend from the viewpoint of the company? What are the advantages if a company decides to issue scrip dividend instead of paying cash dividends? What are the advantages? From the viewpoint of the shareholders, what are the advantages? This is available in your material. Let's go and look at it. Let me go to your material. Yeah, look at it. Advantages of scrip dividends. They can preserve a company's cash position. That is, from the viewpoint of the company, scrip dividend can preserve a company cash position if a substantial number of shareholders take up the share option. That is one advantage from company's viewpoint. Number two, a small scrip dividend issue will not dilute share price. From the company's viewpoint, scrip dividends will not reduce your share price. Number three, from company's viewpoint, scrip dividends will decrease the company's gearing by issuing new shares as dividend to your shareholder. This will reduce the company's level of gearing. That is, it will reduce the company's level of financial risk. These are the benefits of scrip dividends from the company's perspective. These are the benefits of scrip dividends from the company's perspective. Benefits from investor perspective. Look at number two. Investors may be able to obtain tax advantage if dividends are paid in the form of shares. It provides tax advantage for shareholders. It provides tax advantage for shareholders because your scrip dividend will not be taxed. It is only cash dividend that will be taxed. Number two, from the investor's perspective, investors looking to expand their holdings can do so without incurring transaction cost of buying new shares. These are the benefits. Then the last aspect of the question. The last aspect of the question. Briefly explain each of the following terms. Residual theory of dividends, clientele effects, a bird in the hand argument, asymmetric information. Right? Explain this. You have it in the question. Residual dividend policy. We have explained this before. The theory says that there's an optimal amount of dividends. The optimal amount should be paid as follows. We have explained this today again. Number two, yes, clientele effects. Because you may be asked to write short notes on any of these following. What is clientele effects? I need to explain this. This analysis argues that in the real world, there are differential tax treatments. There are differential tax treatment of dividend and capital gain. I've said this before. The income on your dividend is taxed differently from the income you get from capital gain. Your capital gain is if you dispose your shares and you make a profit. And there are transaction costs on shares dealing. What is clientele effect? Some clients will prefer a policy that pay them dividends regularly. Some shareholders will prefer companies that pay dividends regularly. While some shareholders will prefer capital growth in their investment value. That means your dividend policy will attract certain class of shareholders, of investors. The dividend policy of a company will give rise to clientele effects. Certain class of shareholders that prefer dividend income. That means those class of shareholders that prefer dividend payment, that is our own clients. They have invested in our company because we pay dividends regularly. So dividend policy will create clientele effects. Maybe First Bank pay dividend regularly. First Bank as a bank. always pay dividends every year. That means if I'm invested in dividends, I should invest my money in First Bank. Zenith Bank, on the other hand, favors capital growth. That means if you are interested in capital growth, invest your money in Zenith Bank. That means that is clients now. The bird in the hand argument, we have explained this also. That is the resolution of uncertainty. A bird in the hand, what two in the bush? Investor will prefer dividend received in form of income. Investors will prefer to receive their return in the form of dividend that is guaranteed than capital gain that is uncertain. Some investors may find capital gain more tax efficient than dividends. And some investors will avoid transaction costs if their return are delivered in the form of capital gain rather than dividends. However, despite all this, investors generally have a strong preference for dividend because dividend is certain. Capital gain is uncertain. So investor will prefer what you receive in your hand that is certain than capital growth that is uncertain. That is the bird in the hand argument. The last one, information asymmetry. The term information asymmetric means that in a situation where some stakeholders have access to more information about the company than the other, there's information imbalance, information asymmetry. Some stakeholders have access to more information about a company than others. In particular, the management has access to all information about the company. The company's directors, they are also part of the stakeholder, but they have more information than other stakeholders. The directors are involved in the day-to-day management of the business. Shareholders are not involved. That means management or the company's director, we have access to more information. And they are in a better position to decide on dividend policy. The shareholders will only have access to publicly available information. For this reason, the company's management will always take responsibility for dividend decision. All right. We are done with this explanation. And by extension, we are done with this topic. Any question, please? If there's no question, we shall stop here. We shall stop the class here tonight. We can't start a new topic tonight.